the first Bank of Canada interest rate announcement of the year. For a fourth time, the key lending rate stays where it is at 5%. Here's the bank's governor explaining why and what's ahead.
If new developments push inflation higher, we may still need to raise rates. But what it does mean is that if the economy evolves broadly in line with the projection we published today, I expect future discussions will be about how long we maintain the policy rate at 5%. Governing Council is concerned about the persistence of underlying inflation. We want to see inflationary pressures continue to ease and clear downward momentum in underlying inflation.
And we've got a panel of chief economists here to break down today's decision. Avery Shenfeld is Managing Director and Chief Economist of CIBC Capital Markets, and Jimmy Jean is Vice President and Chief Economist and Strategist for Desjardins Group. Hello to both of you. Thanks so much for making the time for this. Mr. Shenfeld, I'll start with you. That comment today that particularly stood out to me from the Bank of Canada's governor was around how the conversation at the bank's governing council has shifted from whether they're being restrictive enough to how long they're going to stay at 5%. What do you take from that comment?
I think it's pretty clear that they're assuming themselves that they're going to be cutting interest rates sometime before the middle of the year, around the middle of the year, because in their forecast, they talked about a pickup in growth in the second half tied to easier financial conditions, and that's just code word for their rate cuts. And then also when they talked about inflation, they said one of the components of inflation, which is the part that's tied to renewing mortgages at ever higher interest rates, is going to start to slow down. And again, they'll need to be cutting interest rates in order for that to happen. So they're just debating amongst themselves when they start easing, but they're pretty, I think, assured that inflation will eventually come down and that they need to start giving the economy a welcome dose of relief this year.
What do you think is informing, Mr. Jean, the discussion around the question of when? Mr. Shenfeld pointed to a couple of things like where inflation is at and the degree to which the economy is being impacted. How do you think that is informing ultimately the question of when?
Yeah, well, I'm concerned that unfortunately that decision is being informed by rear view analysis to a great extent, because they talk about realized inflation and how this is sort of disappointed. They talk about pressures on shelter costs, and part of it is indeed, as Avery mentioned, is implicit to interest rates. They talk about wages, which we know is a lagging indicator. So a lot of rear view mirror analysis when in fact, they have that steamroller, which is those renewals. Their own analysis suggests that it's the average borrower will see an increase in payments of 34% when this whole process is said and done, and even assuming rate cuts eventually. So, I think you're looking at the Canadian economy and, even that historic pace of demographic growth is not able to fully offset the impact of renewals. And here they are just, worried about how they're going to get to that 25% that's left to 2%, and how that's going to be the deciding factor in terms of when they can cut. When I think in fact they can trust that what they're doing is working and think about doing those rate cuts sooner rather than later.
What do you think about that proposition, Mr. Shenfeld, going even in small doses sooner rather than later, trusting that those rate cuts rate hikes are going to have the desired effect, and we're already seeing signs that they are?
I think they understand that a slow economy will eventually bring inflation down. They could end up cutting rates as early as April. I mean, it might be April, it might be June. I actually don't think the economy is that dependent on exactly when they start. I do think they're going to have to move reasonably steadily and fairly aggressively, maybe 1.5% cut this year, because of those mortgage renewals, because the economy is stalled, and because the governor, in his own words, has repeatedly said that he doesn't see the need for an outright recession to get inflation to 2%. The economy right now is hovering on the edge of recession. We aren't really growing. We're declining in output in per capita terms. So, there's a saying, better late than never. I don't think that applies in this case. I think they do have to move relatively early, but I don't think the spring would be too late to rescue the economy from the doldrums that it's in now.
If the counter, Mr. Jean, is that inflation, and Mr. Macklem referred to this today, it remains pretty sticky, right? And in certain areas in particular. And if that's the portion of the calculation or the part of the calculation that is holding them back from rate cuts, how would you respond to that concern?
Well, I mean, it's an environment where you can't be aiming for perfection. I mean, it's you're still going to be dealing with supply shocks. You have a lot of lagged influence in the environment. The Bank of Canada mentions itself that you have supply constraints, especially in housing, that is preventing the adjustment to the same extent that you would have seen in the past. But when you look at the inflation expectations, yes, they're still high, but they're still moving in the right direction. Inflation, I mean, it's elevated everywhere, but it's coming down as well everywhere. And in the case of Canada, you have an economy that's highly sensitive to interest rates. So right now, we're talking about an economy that has stalled. But if we want to get to that perfect situation on inflation, we're going to be talking about initiating rate cuts when the economy is in recession and has been in recession for some time. So I think, the better way to go at it is to begin sooner and allow for a smoother process of interest rate cuts rather than unnecessarily waiting and having to knee-jerk as a response later on.
Mr. Shenfeld, how do you account for the difference in economic growth in the U.S. relative to Canada? Is it, I know that, we have fiscal stimulus, they have a lot of fiscal stimulus. Is that it, or is there more to the story?
I think that's part of it. The other part is that their household sector was a lot less indebted than ours. And unlike Canadians, Americans are locked into 30-year mortgages that they took out in many cases in 2020 when rates were very low. So as long as an American doesn't move, they're not impacted by higher mortgage rates. Those are some of the big differences between the U.S. and Canada. It's why, as Jimmy mentioned, we are historically a bit more sensitive to interest rate hikes, and why the Canadian economy is therefore showing more urgency to get interest rates moving lower. The financial markets are betting the Federal Reserve will cut more aggressively than the Bank of Canada because they have made a little more progress on their inflation measure. But their inflation measure, their official one that they track for monetary policy, doesn't put as much of a weight on housing. So they're kind of measuring apples and oranges here. I think the Bank of Canada does have to probably move a little more aggressively than the Federal Reserve in the U.S. because, as you mentioned in your question, the U.S. economy is weathering the storm of higher rates a lot better than Canada's.
Last question to you, Mr. Jean. When we talk about the concept of being more aggressive in rate cuts, where does that, in your view, put things at the end of 2024?
Well, in our view, rates will finish the year at 3.5%. So that's 6 rate cuts. Now, when you look at things on a real basis, so after taking into consideration inflation, even that 3.5% won't bring back monetary policy into the neutral level. I think we'll be on the edge of neutral, but it's still going to be, for the better part of the year, still a restrictive policy. So it's not inconsistent with what Mr. Macklem is saying, which is that we need to to provide more time for monetary policy restriction to act. It's not because you start dialing down slowly the level of restriction that you're all of a sudden flipping on the other side. It's just that you're going at it in a smoother way that will prevent injecting unnecessary volatility into the economy.
Mr. Jean, Mr. Shenfeld, I'll leave it there. Appreciate your analysis this evening. Thank you.